Hi guys, this is Dmitry. I'm coming to you on behalf of the Golden Ticket, which is a subsidiary of Para Investments. If you like these videos, feel free to join our Discord. It is completely free. We do free calls on there. You know, we have an amazing staff. Obviously, we do have VIP calls, which you could register for on our website. And also our website does have the link to our free Discord. And the website's link is below in the description as well as in the profile of our YouTube. And today what I want to discuss is options for safer investments. And what I mean by safer investments is quite simple. It's going to be investments that are able to bring you returns without all the inherent risks that come with, like standard investing. When I say by, standard investing, I'm talking about just getting a call or just getting a put, just, going long or going short, where you only have, this one particular play and that's it. And whether you like it or not, if the price goes in the opposite direction of what you were expecting, you are going to lose. With that being said, the way that I think the best, way to accomplish that is, let's do, say, we're going to start off with options, which most of us are playing right now. But the thing is, we're just playing calls. We're just playing puts. And there are other ways that you could play this. And those are called, I'm going to teach you guys two things, a straddle and a strangle. Now, with the case of a straddle, it's pretty easy to understand. Same thing as a strangle. Let me pull up a chart. I'm gonna do extended hours. And for our chart, we also want to get it set up. Make sure everything is good. Okay. So, if you want to play a straddle and a strangle, they're very similar to the way that vertical works, where you buy, a call and you sell a call with very similar strike prices. And if you haven't been caught up on verticals, it is available in our YouTube or on our YouTube channel. We did a whole video on these, options plays. And the reason why I decided to do this Zoom today is because of the results of FedEx. Now, FedEx, it was a risky play, but we could minimize our risk when we do straddles and strangles. So let's go through first what the difference of between the straddle and a strangle are. Well, both of them, they're option strategies, obviously. And they both allow they allow you to benefit from moves in the stock price, regardless of whether that stock price goes up or that stock price goes down. So if you have a straddle on FedEx and you are expecting the price to go up and it goes down instead, you still benefit. And it's the opposite way too. If the price goes up and you were expecting it to go down, you still benefit. How do you benefit? Because you are not basing your entire, you're not basing your entire bet on one play. You're not saying, this is definitely going up or this is definitely going down. No, you're going both ways. So when it comes to straddles, they're most useful when it's unclear of the direction that the price could move in. So let's take a look at FedEx. Okay, so we're going to take a look at this, the 1 minute chart. That's good. Let's just zoom in. So this was right before closing right here. Let's see. Do, 1600 would be where? So, okay, it looks like we're going right up to the after hours. Now I need to turn on after hours on here later on, but I'm not going to do that right now because right now for me it's more important to show you guys how all this stuff works. I'll take a quick look if I could find this after hours thing. If not, then oh well. There you go. So this is what happens to FedEx today after close because they beat their sales. So their sales was done. I mean, their sales was good. However, what wasn't good was their EPS. So say you wanted to play FedEx right before the closing, but you weren't sure, like, where the price was gonna go. Was it gonna go up? Was it gonna go down? You just were not sure about it. So, let's move this a little bit this way so we have space to draw. So after the close, FedEx's price could have either went upwards or downwards. So the price could have either went from here to here, or it could have went from here to here. And you could see that, the latter is what actually happened. So what earnings plays is when plays like straddles and strangles, they come into play. They're very, very helpful at reducing risk. The two lines that we drew, if the earnings went good, then we could see that we would essentially have this variation right here. If earnings went bad, which I guess in this case, they weren't that bad, but the EPS was bad. And plus tomorrow we have the FOMC meeting, which doesn't really help the situation much. Then they're gonna go into this situation right here. So what a straddle does is you're gonna both buy a call and the put at the same exact time. So let's assume the stock's price right, before close, the low point was about $252. Now I'm not gonna use this number for my example because I'm not going to pull out a calculator and give you the exact figures. So to make it, easier, say the stock price is $10 and a call expiring in November cost you $2 and a put expiring in November with the same exact strike pretty much cost you $1. So you are in essence paying, $300. Okay, so you have what's called, you buy a call, which costs you $2. You buy a put, which costs you $1. And both of them have the same exact expiration date of the 19th of November, 2021. Now, because each contract is worth 100 shares, so 100 shares, 100 shares, your total price is going to be $300. And what the straddle would do is it will increase your profits if the stock moves higher because of what's it called, the long position, the call that you open right here, and you're gonna make more profits off of the call. However, if the price does go down, then you're making profit off of the put that you bought. So, in the case that you say completely, messed up all of the calls that you had or the plans. So you thought the company was going to go up in price, and instead it went down in price. So for FedEx, we had a $242 price before closing, I think. And it drops down, or was it 252? Let's check it out. 252, I'm sorry. But whatever, we're gonna stay with 242. Like I said, this is just theoretical example. And the price goes down, you are protected by this because you bought a put saying that the price is gonna go down. Now, you're gonna lose money on the call that you bought. However, because you have this open put right here, you are essentially reducing your losses by 50%, if not more. So the straddle will increase in value if the stock moves higher because of the long call option, or if the stock goes lower because of the long put option. So we bought a put and we bought call. So regardless of where the price goes, you're making money one way or another. The difference between this and a vertical is a little bit harder to explain because vertical, you don't buy a put. You essentially, in a vertical, you buy a call and you sell a call. So if you were to try to compare vertical, which would be a spread, or a straddle, then the difference would be is when you do verticals, which are spreads, it's meant for an investor who is moderately or somewhat bullish or bearish on a security. So if you're, say, you have this good feeling that the security is going to go up, so let's just go ahead and clear this out. So we have stock A, B, C, and you are 75% sure that it's going to go up. That's when you are going to do a bull spread, which is a bullish vertical, meaning you buy one call and you sell one call, except the call that you buy. So you're buying one call, selling one call. The difference is the one that you're buying is going to have a better strike price than the one that you're selling. Now, what do I mean by better? Because you're bullish on it, then you are going to buy the call that is in the money, ITM. And the call that you're selling is going to be further out of the money, OTM. So if we did this with FedEx, for example, it's 252, and you did a vertical or a bull spread, then the call that you would buy, the strike price would be, say, 255. The call that you would sell, the strike price would be 260. This way, if the price does go up, you will make more money because this has a lower strike price than the one that you sold. However, in the case that the price goes down, the call that you sold is going to bring in money and reduce the losses that you took on this play right here. So instead of losing, say, your total investment on a bullish vertical spread was 7,000. That's how much your option contract costs. So that's the contract fee. And that is your maximum loss. When you buy and you sell a call, what's going to happen is, first of all, you're not going to pay this much money. So instead of 7,000, you'll probably end up paying somewhere around 1 to 2K. Why? Because when you sell a call, you're going to get credited money. And when you buy the call, you're paying money. Now, what the way this comes out to this amount is it's going to be your debit from buying and your credit from selling, and you get back the difference. And this could go both ways, whether it's bullish or bearish, if you expect the price to go down or you expect the price to go up. So that is a spread or a vertical. You know, if it's a put, the one that you buy to make money off of should be either in the money or at least near it. Or if you are bullish on it, then the call that you buy should be the same exact thing as this. And the one that you sell, whether it's a put or a call, you should be getting the one, the one that you're selling should be further out of the money. So if you are playing A, B, C, then the one that you buy should be an ABC at say $10. The one that you buy should have a strike price of 11. The one that you sell should have a strike price of 12. And that's how vertical spreads work. So these are spreads. And they could go either bullish or bearish. Bearish meaning you're betting that the price is going down. Bullish meaning you're betting that the price is going up. So now let's do our straddles. And then we're going to get to the strangles. The way a straddle works, or once again, you could have bullish and you could have bearish straddles. It doesn't matter. It works as a neutral strategy. Now, with the verticals, or the bull spreads or bear spreads, you are still like expecting money to come from a particular security, whether it's going down or up, but you are still biased towards something. Now, a straddle is more of a neutral strategy. The strategy basically involves simultaneously, which is the same thing as you do on a vertical. Like on the vertical, so we're gonna put here our vertical info, and we're gonna compare it. On the vertical, you buy and sell a call or a put at the same time. Now, on the straddle, you are buying a call and are buying a put. So how do these two things differ from each other? Well, it's really quite simple. When you sell a call and buy a call, you're essentially selling somebody a security or a contract that they're going to buy because they expect that price to go up. And you're also buying it because you also expect that price to go up. So you are biased in a way, but you want to have insurance. So the main thing here is your insurance in case you're wrong. But in the case that you're not wrong, you still make money from the buy, and you're going to lose money on the sell. However, because your strike price on the buy, with your strike price, I'm just going to use SP, was closer to being in the money than your sell price was, you're going to profit on this more than you lose on this, meaning you come out a winner if you were correct about where you thought the stock price was going. Now, a straddle is different because this is neutral. Some people, they have asked me before, could you even lose money on a straddle? And yes, there's always a potential for loss, no matter what you play. But you have two types of straddles. You have a long straddle and you have a short straddle, meaning you are essentially, going either for the long or you're going for the short, either buying or selling. And what you want to do, the way it looks. So we have our chart right here. And over here, we're going to put our profits. And here, we're going to have the break even. So over here, you have plus 1,000. Over here, you have negative 800. And the reason why it's negative 800 plus 1,000 is because this is a long straddle, meaning you still want the price to go up, but you also want to risk less. Now, with a straddle compared to with a vertical, your strike price for both the put and the call that you are buying, you're buying both, is going to be the same. Now, and the way that works is it's used in usually the case of a very volatile market. So this is the best time to use straddles right now, with the FOMC meeting coming out, with all these Fed talks, with people not knowing inflation rates that are be coming out next year, labor wages, and you are expecting a big move of a price in this asset, whatever this asset is. It could be, let's say for tomorrow, KBH. Now you're expecting a big move, but you do not know in what direction that move is going to go. So you really don't know exactly, what is happening. So you buy a call, you buy a put, and there's going to be an unlimited profit ceiling for you, but there's going to be very limited reward and very limited risk, because essentially the way this works is those price, let's say, what is it, 40, 50, 60, 70. And this right here is going to be the price at expiration. So that's the strike price on your call. Somewhere over here is going to be your put, somewhere in this area. The way a straddle works is it's formed like this. Because you bought the put and you bought the call, and both strike prices are exactly the same, and both expiration dates are exactly the same, your view on this play remains neutral. And the chance of you losing goes down from, say, 50 down to 20%. So now you see just why people play straddles. And you're going to see that word a lot. If you read the news, especially on TD Ameritrade, you're always going to see people talking about the straddle plays that are happening right now. And the reason why that is because investors prefer straddles, because even though you thought that the price was going up over here and you turned out to be wrong, then it's okay, because your put is still covering you on this end. And this line right here represents your profit and your loss. So if the price goes down, your put that you bought pays off there. If you were right, the call that you bought pays off here. This manages your risk, and it also allows for you to sleep better at night, because now you have insurance again. So the difference between, again, I'm going to repeat it, a bull spread or a bear spread and a straddle is the straddle has 2 break-even points and you are staying neutral. Now, because of the fact that, I'm going to go through a couple of scenarios with you. Say the put expires worthless, which is scenario 1, by the way. This is scenario 1. And the call expires worthless. So you did not get to the strike price on neither the put nor the call, then you lose money. And, depending on how much the straddle cost you, is how much you're going to lose. Now, scenario 2, I'm going to clear this out again. So this is scenario number 2. Say the put that you got expires worthless, but the call that you have expires in the money. Then you make profit. Very simple. And scenario 3, the call that you bought expires worthless, but the put you bought expires in or close to the money. And again, make a profit. So if we go back to our original chart where it looked like this, put, call. If both of them expire worthless, which would be here, then you're gonna lose money, negative. However, since you have the same strike on both of these, you're almost guaranteed that you're gonna come out a winner. Why? Because if you're wrong, the price goes down, you make money here. If you're right, the price goes up, you make money here. That's why it's considered a very neutral strategy. So that is essentially how straddles work. After this, I'm gonna go into strangles. But to give you just another quick example, we're gonna actually show you how everything is gonna happen. So we have profits here at 1,000, 850, 750, break even, then negative 650, negative 750, negative 850. So we're gonna do, let's see, how am I going to differentiate? For green is gonna be the case that, you know, our call pays off, and red will be the case that our put pays off. And this over here, we're gonna put strike prices of 10, 20, 30, 40, 50, 60, 70. Now, for yellow, we will use where you bought the straddle. And the green line, like I said, it's going to be the our call that we bought. So we had a strike price of, you know, say somewhere in the 50s area. And this would signify your, what's it called, wins from your call. This would signify your wins from your put. And the blue we're going to use strictly just, you know, to show how you could lose and how the payoff works, because you both have a call and a put at the same time right here. The reason why that blue line is there is because there is the possibility that both expire worthless. And that's where your loss comes in at maybe around the $650 mark. Obviously, depending on what asset you buy, most brokerages do have, you know, these charts that are automatically generated for you. So this chart is not an accurate representation. I'm just, you know, drawing it by hand to give you an example of how a straddle works. Now, let's go to the last one for the day, which is a strangle. So another way of playing a straddle-like strategy is called a strangle. And as I just said, strategy, when it comes to options, all depends on how you feel about that security. So a straddle is going to be a position which is non-directional. Same thing as I say with the ADX line. It doesn't care if the trend is up or down. It's just showing you a line. It's the same thing with a straddle. It has no, it's not biased. Now, a strangle is when you do have a better chance, similar to a spread, of a stock or any security moving in a specific direction. However, you still want to be protected. So you think, okay, KBH is probably going to go up tomorrow after hours. We had good news in the real estate sector, you know, this and that. And I know that the real estate sector hasn't blown up. Chances are, and it's a low volume stock, if it reports good earnings, it could shoot through the roof. So I feel good about KBH. I want to be able to, invest in it, and I want to get paid well if I'm right. But I still want the protection, the insurance, in the case that I am wrong. So instead of buying the put option, so remember how on a straddle, let's write that down. On the straddle, we bought a call and a put at the same strike and expiration. A strangle works exactly the same way as a straddle, except now we buy a call and a put, but because we have this bullish feeling, we feel like, this stock is really going to move, then we make our put strike different than our call strike. For example, we're going to use KBH because that is a play that we are doing tomorrow. So that's why I am constantly just adding, KBH into the mix. So instead of buying a put option with a strike price of, say, $40, I'm going to look at a strike price that's a little cheaper. So, I'm going to go for 45. While my call is going to be 40. So because the call option that I bought is more expensive and has a higher delta, well, delta basically on a put is always negative. Oh, it's always positive. You're making money as dollars drop. It's just the inverse. If you guys don't know how puts and calls work, go back to the videos. But because my premium for the call is going to be more expensive, because of the fact that my strike price is closer to being in the money, the call is going to pay more. And since my put is cheaper, if I am wrong, it's going to pay less. However, if I am wrong on my call and I am seeing that the price is flying down, the put is offsetting my total loss by as much as 78%. The catch to that is if I was just to buy a straight call and completely ignore this, I would get paid a lot more money. But if I was wrong, I would lose a lot more. So that's why people do a strangle. And once again, you could have either a strangle that's bearish or bullish. And, it could all be reversed. Say I felt bearish about a stock. Then what am I going to do? I'm going to buy a put price. So put price is going to be closer to in the money than my call price, making my put pays more and my call pays less. So in reality, at the end of the day, it's all about covering your own. It's like house insurance, car insurance, whatever you want to call it. But you're betting against your own bet. But with a strangle, you're putting more money into you being right and less money into you being wrong. So in the case that you are correct, you get paid more than you would on just, a regular straddle where you remain neutral. So recap, to do a recap between the three things that we did discuss today, it's straddle, strangle, vertical spreads. Vertical spread, you choose bullish or bearish. And for vertical spreads, you buy a call and you sell a call. You buy a put and you sell a put. For straddle, you are market neutral. You buy a call and what's it called? Sell. You buy a call and you buy a put with the same strike price, same expiration date, and see where it goes. And with a strangle, you are not market neutral. Now you're leaning more towards one direction. So you're either a little more on the bearish side or you're a little more on the bullish side. And you buy a call and buy a put. However, that call, if you are bearish, is going to have a strike price closer to in the money than the put, because that way, if you're right, it's going to pay more. If you are bearish instead of bullish, then the put is going to be closer to in the money than the call. So if you are right on the put, it pays more. And the reason why you are buying the opposite with a different strike price, depending on the play, when it comes to straddles and strangles, is for insurance purposes. So you do not completely lose everything. So you don't expire worthless losing everything. So I hope this has been helpful and showing you guys how to minimize, the losses that you could potentially take on the market. Once again, my name is Dmitriy on behalf of Golden Ticket. Link to our site is below. Feel free to join our Discord. The link to our Discord is on our website. And we do run these educational Zooms every Friday. And once in a while, I'll feel the need to just throw a pop-up Zoom in the mix, because I feel like I could give you guys some piece of knowledge that will help you become better investors while taking less risk. I wish you guys the best of luck on the market tomorrow. If you haven't signed up for our VIP alerts, you always have the option to do so. VIPs usually get plays, 2-3 days earlier than I will send to Discord, because that's when I first get them. And also, it helps support our Discord and keep everything going, keep the Zooms going, things like that. Before you go, here are 3 free ways that we can help you become a more profitable trader. You can join our Discord channel. Also, subscribe to our YouTube channel for all the latest videos and like this video. Thanks everybody for watching. More videos to come. We usually do them once a week, and I will see you later.